At this moment, AI stocks are testing all-time highs. Every minor dip is met with a wave of retail buying, as investors rush to ensure they aren't left behind by the next leg of the rally. But while the price continues to climb, the underlying structure of the market is beginning to crack under the weight of its own momentum. Behind the scenes, institutional players are building complex insurance structures, looking for ways to offload the risk of their massive positions. This creates a buffer, allowing the largest players to move their chips, while the retail crowd provides the necessary liquidity to keep prices afloat. To survive this environment, you have to look past the top-line price and identify exactly where the smart money is stashing the danger. Investors often focus on the PE ratio, assuming that if earnings are rising, the valuation is safe. Right now, AI hardware companies are booking massive profits that seem to justify their sky-high stock prices. This chart highlights the disconnect. These record earnings are driven by one-time capital expenditures, CAPEX purchases, rather than the sustainable, recurring revenue investors usually rely on to value a business. We saw a similar dynamic in 2006. Bank earnings were buoyed by an explosion of mortgage origination fees, which kept their valuations looking steady despite the rising risk in the housing market. Once the housing build-out reached its limit, the origination fees dried up, and the banking sector lost its primary engine of growth almost overnight. Relying on PE ratios during a massive build-out phase is dangerous. These earnings reflect a temporary spike in hardware demand, which can disappear the moment the infrastructure is complete. If the long-term outlook for AI is as bright as the headlines suggest, then we have to ask why the largest financial institutions are going to such extremes to ensure their downside. Take this $36 billion deal structure involving Google and Anthropic. Investors like Apollo and Blackstone send cash to a special purpose vehicle, which then buys custom chips from Google. The SPV then leases those chips to Anthropic. The lease payments flow back to the investors, keeping the cash moving. But the deal includes a chip put. If Anthropic fails, Broadcom steps in to pay the investors any shortfall. Broadcom is essentially renting out its investment-grade balance sheet to ensure the deal. This structure assumes tech hardware will hold its value, but history shows that today's cutting-edge chips can become tomorrow's obsolete hardware with the release of a single new model. The complexity of these insurance deals proves that institutions are building their own exits, even while the public narrative remains focused on the rally. Since you aren't sitting in those boardrooms, you need a way to spot this institutional positioning on your own charts. This chart shows the accumulation distribution line, or ADL. It tracks the relationship between a stock's price action and its volume to see if the big money is actually supporting the trend. Institutional distribution is often subtle. It's like a toddler claiming they cleaned their room by shoving all the mess out of sight under the bed. On the surface, the price looks clean and rising, but underneath, the ADL is revealing a different story about where the money is actually flowing. When the price hits new highs, but the ADL trends lower, it suggests that large-scale sell orders are being filled by the excitement of the retail market. The market is functioning as a system designed to transfer risk from the architects of these complex deals to the investors who only look at the surface-level momentum. Buying the dip becomes a liability when the underlying risk is being systematically shifted toward the most accessible part of the market. To navigate this, you have to verify the trend. Look for the signs of distribution and recognize when current earnings are tied to a temporary build-out rather than a long-term business model. Surviving the AI boom requires using hard data to track where the risk is hiding, rather than trusting the noise of the rally.